Have you ever looked at your house and wondered if it could be the key to buying another one? It's a common thought. Today, we're going to dive deep into that question, not just if you can do it, but more importantly, if you should. So let's get right to it. Can you use the equity in your home to buy a second house? The short answer is yes, absolutely. But, and you knew there was a but coming, right? This isn't some simple financial hack. It comes with some really incredible rewards, but also some very, very serious risks that you've got to understand inside and out. So really, we're trying to figure out if this is a smart move or a huge gamble. And honestly, it can be both. This is a high-stakes decision. So in this explainer, we're going to break down exactly how it works, what the potential upside looks like, and the major risks you'd be taking on. Okay, but before we get into the pros and the cons, we have to start with the basics. First things first. We need to be crystal clear on what we're even talking about. What is home equity, and what are the financial tools you would actually use to get your hands on it? So let's talk about the star of the show, home equity. What is it really? Well, the simplest way to think about it is that it's the part of your home you actually own. It's what your house is worth on the market today, minus whatever you still owe the bank on your mortgage. Numbers make this way easier to grasp, so let's run with a simple example. Imagine your home is valued at a nice, round $1 million. And let's say you've paid it down over the years and you only owe $500,000 on it. You just do the simple math. 1 million minus 500,000 leaves you with $500,000. That is your home equity. It's this chunk of value just sitting in your property that you could potentially tap into. It's the key that could open the door to that second home. So how do you get that money out? Well, the most common tool is a home equity loan. This is pretty straightforward. You get a one-time lump sum loan. There's also something called a HELOC, which works more like a credit card that's secured by your house. But for a big one-time expense like a down payment, we're mostly going to focus on that home equity loan. All right, now that we've got the nuts and bolts down, let's get to the good stuff. Why would anyone even consider doing this? Let's dig into the potential payoff that makes this strategy so incredibly tempting for homeowners. So what's the big appeal? First, it's a way to get your hands on a huge pile of cash for a down payment, and pretty quickly too. Second, the interest rates are generally much lower than what you'd get on a personal loan because your house is acting as collateral. And maybe the best part of all, you can tap into your home's value without having to actually sell it. And this is where you can really feel the power of it. Let's say you pull out $300,000 with a home equity loan. Suddenly, that could be a 20% down payment on a $1.5 million property. I mean, think about that for a second. That is some serious financial leverage in action, using one asset to acquire another. Okay, that all sounds fantastic, right? But with great leverage comes great risk. We absolutely have to flip the coin over and look at the other side, the serious, sometimes hidden drawbacks that you cannot afford to ignore. This really is a high-stakes balancing act. On one side, you've got quick cash and relatively low rates. On the other, you're taking on a whole lot more debt, and with it, the very real risk of foreclosure. It's a financial tightrope, and you have to be sure you have a safety net. And I want this quote to really sink in, because it gets right to the terrifying heart of the matter. You're not just risking the new property you're buying. You are borrowing against your original home, which means if things go wrong, you could lose both. Let me just say that again because it's the single most important point. There is a foreclosure risk on both homes. Life happens, a job loss, an unexpected medical bill, and if that causes you to default on that home equity loan, the lender can foreclose on your primary residence. Your family home could be on the line. And what about the cost of borrowing this money? Well, home equity loans kind of sit in the middle of the pack. They're typically cheaper than an unsecured personal loan, which is great, but the interest rate is almost always going to be higher than a traditional mortgage. So while it's a decent option, it's not the cheapest money out there. So a home equity loan is a powerful tool, but it's really important to remember it's not the only tool in the shed. Let's quickly go over some of the other paths you could take to finance a second property. Of course, there's always cash savings. That's king, the safest way to go. You could get a personal loan, which is unsecured, so your house is safe, but you'll pay for that safety with much higher interest rates. There's also a cash-out refinance where you get a whole new, bigger mortgage on your current home and pocket the difference. And of course, there's that HELOC we mentioned, which gives you a flexible line of credit. Okay, so we've looked at how it works, the potential rewards, and the serious pitfalls. Now, it all comes down to your financial bottom line. This is the part where you have to be brutally honest with yourself and your own situation. If you take away just one thing today, please let it be this. Tapping your home's equity is not free money. It might feel like it, but it's not. It is debt. You have to pay it back, with interest, every single month. And you have to be absolutely sure that you can handle those extra payments, no matter what curveballs life throws your way. And so we land on this final, crucial question, the one only you can answer. For you and your family, is the potential reward of owning that second property worth the very real risk you'd be putting on your primary home? The answer is different for everyone, and it's one you have to think about long and hard.